Hello and welcome to this Holmquist and Gardner Insight on preparing for CMBS or agency loans. As always, this is for informational purposes only and should not be construed as actual legal advice. For that, you'll need to retain your own counsel, which may or may not be our firm. In this insight, we're going to cover why CMBS or agency loans are different than your normal bank loan, credit union loan. We're going to tackle a couple of different categories of issues and ways that you can be more prepared for those and come out as on top as you can, including entity issues, sponsor and sub-entity issues, assembling the team, and issues with the collateral. So for starters, you have to recognize right away with CMBS or agency loans, and by agency loans we mean Fannie Mae, Freddie Mac, or HUD, is that these are an entirely different beast from going to your local bank or credit union. If you did that, it was a quick loan, it was on Laser Pro documents. The credit agency, or instead of an agency, you had actually a committee at the bank reviewing your due diligence materials, and they can sometimes make exceptions because they're the bank, they're local, they're the sole funding source. With an agency loan or CMBS loan, it likely is being marketed to third parties to take down tranches of the loan, or in the case of agency loans, there are extremely strict guidelines. So there is zero flexibility on the issues that come up. In addition, there are going to be an amazing amount of additional administration. Almost every borrower that does this for the first time is going to be overwhelmed at some point. And it doesn't matter how sophisticated you are going into it. If you have not done a CMBS or agency loan, hold on to your shorts. Almost nobody goes out of their first closing of one of these loans and goes, man, let's do that again. It is just a different beast. You have to appreciate that. That is your number one way to be prepared heading into your first CMBS or agency loan. There's a reason for that though. Typically, all that administration, the extra attorneys and opinions, the extra work you have to do is because it becomes a means to an end. This loan product has some advantages for one reason or another. Typically, it's going to be that you either have better business terms, meaning the interest rates are lower, or it's interest only, or there's more creativity on behalf of the lender in terms of the amount of cash out that can happen or the business terms that support that loan. Whether that's vacancy rate or management or years of operation or experience, you're going to see some differences there that make it such that all this administration and everything we're going to cover today is worth it. You have to keep reminding yourself of that as you go through this. So one of the first things you can do to be prepared for a CMBS or agency loan is put your team together and make sure it's experienced in this area. So you're going to have, generally speaking, a very experienced lending advisor, mortgage broker who's been through this process many times and is going to help you along the way. They're also going to be like a psychologist for you. So get ready for that. On the team, you're going to have a great title team. Hopefully you're using a title company that helped you on the way into this piece of collateral so that they know the real estate already. You're going to have a great surveyor that you've already used in the past. Obviously, you want to make sure that's approved by the lender before you retain them. And you're going to have a management company that's used to the CMBS and agency issues and requirements so that when their management agreement goes under review, it's not called into question or certain terms don't cause issues with them. And they're not scared off by an assignment of that management agreement, which will be a part of the loan documents. Finally, you're going to want to have experienced counsel. Experienced counsel will have done many of these types of loans. This will not be their first rodeo. This team and basically being prepared in the ways that we're talking about today are going to lower your legal tab, because the more you're prepared and ready to go, the less not only your lawyer is going to have to do to help you get prepared, but also the lawyer that's being hired on behalf of lender is not spending all that time, or better stated, your money in the form of their time to handle all of these issues. What are some of the issues that we can address early on? The number one on my list is certainly entity issues. So for these types of loans, you are typically going to be required to start a new Delaware entity that is a single purpose entity. Now, you may have set everything up that way from the get-go, that's fine. But if you have not, you're going to need to transfer the real estate into a new Delaware entity that is a single purpose entity. The reason for this is that the guidelines require that there's no other business activity that has happened, and they will not just take your word for it typically. They will require that your operating agreements for the holdco have provisions that they have already agreed to and approved, and that lender finds acceptable, including but not limited to that this business is only going to operate this piece of collateral and has never operated anything else. They're also going to make sure that this is a bankruptcy remote entity. And to make sure all this is happening and happening timely, you'll want to get out ahead of this by starting that entity process as quickly as possible. Because during the closing process, you will need to get certified copies of certificates of formation. You'll be getting a new EIN. All of this is just administration that you could probably get out ahead of prior to starting the process. Another piece that you can dial in is your sub-entities. So if you have a number of trusts or you have a diverse investment list or investor list, those are all things that you're going to want to have pristinely clear, because the lender is going to look at all of those trust documents and any investment documents that are there. So you can look at those and make sure that those are in pristine order and ready to go. Finally, we can look at collateral issues ranging from from the dirt itself, so the survey, boundary line issues, certificates of occupancy. They will not accept a temporary certificate of occupancy. You will need to get the final, and any licensing on the property to operate the property in that condition, whether that's an alcohol license or hotel license, all will need to be in the name of the holdco. You can see where this might present an issue, given what we just talked about, that you're going to have to start or may have to start a new Delaware entity. All of those licenses, everything needs to be transferred effectively prior to closing. So you're going to want to be prepared to engage in those efforts. With regard to the financials of the property, you can start many months out or even years out, making sure that your P&L sheets and financial statements are all dialed properly. Work with your mortgage broker, CPA, to make sure that those are compliant with agency and CMBS requirements. If you have any outstanding litigation or pending claims, these are all going to have to be disclosed in this process. The 150+ page loan agreement that you will sign in a CMBS loan is going to be somewhere between 6 and 10 pages of reps and warranties. What that means is, if you can get out ahead of any of those by not having those claims open at the time of going for your loan, that would be optimal. If you do have to disclose something, we would say that it's best to disclose that way early in the process. If a litigation issue or a pending claim of a material nature arises a few weeks before closing, we get back to what I said earlier about increasing your cost, as lawyers on both sides have to spend time and money evaluating that claim and the materiality of it. One of the key differences between normal loans or bank or credit union loans and a CMBS or agency loan is going to be the number of attorneys that you get to work with. In a normal loan, it might be that you don't end up using an attorney, or your attorney is just reviewing your Laser Pro loan documents, and maybe you pay a small lender legal fee to your local credit union. In a CMBS or agency loan, you're going to have likely a large New York firm or nationwide firm on lender's side that will accrue fees and on your behalf, on lender's behalf, but which you will pay. And you're going to have a local counsel opinion for the state of Washington, if you're in Washington, a Delaware opinion, and a New York opinion, because all of these loan documents are, at least for the agency or for CMBS loans, are going to be governed by New York law. This is a different category of legal fees. And so you want to be prepared for that in advance and understand that your preparation level will lower all of those fees. Thank you for taking the time to watch this quick insight. We hope you found it interesting. If you have further questions on CMBS or agency loans, feel free to reach out.